Hello.
Hello, Cristina. How are you?
Just fine. Thank you so much for inviting me to speak to your amazing event. I'm so sorry we can't do this in person.
Thanks for accepting our request, and thanks for being with us. So let me start with a short introduction. I'm Yiğit Atılgan from Sabancı University, and thanks for joining our webinar titled COVID-19, Financial Technologies and Small and Medium Enterprises. So this webinar is organized by Center of Excellence in Finance, founded under the sponsorship of Akbank. Of course, we would have preferred to meet all of you face-to-face, as we did in the past. But today we're going to be hosting our guests, thanks to the opportunities provided by technology, which is actually fitting with the theme of our event. Again, I would like to welcome Cristina Dolan'ın, who's joining us right now from New York City. We had the privilege of hosting her in our annual conference a couple of years back, and we are excited to listen to her once again. She will also talk about her journey in a minute, but I would like to offer some introductory words for Cristina. She's the CEO of InsideChains, which is a company focused on building and growing businesses utilizing data science. She's an entrepreneur. She recently co-founded iHuddle with BlackRock alumni. And iHuddle utilizes open banking connectivity to democratize access to accredited level investment opportunities. She's a co-founder of Aditum in the healthcare health tech business, and she also co-founded IX Ledger, an early blockchain-enabled insurance marketplace. She also formerly held executive roles at corporations such as Disney, IBM, Oracle, and Hearst. All in all, she has over 2 decades of experience building transformational businesses for FinTech, InsurTech, media, telecom, and health tech. She holds a master's degree from the MIT Media Lab, and also a Master of Computer Science and a Bachelor's of Electrical Engineering. And that is just a summary of Cristina's many accolades. So before I yield the floor to our guests, I want to tell our audience that we will have a short question and answer session after the presentation. You can type up your questions in the chat box during the talk, and we will direct your questions to our speaker after her talk. So Cristina, thank you for being with us, and the floor is all yours.
Eugene, thank you so much. And I will start with my screen here, but I just wanted to thank you. I mean, I really enjoy your conference, and I'm sorry that this year we can't do it in person, but hopefully this topic will be just as exciting to everyone over the technology. All right, so I'll share my screen now and start the presentation. So, as Yazid said, I am going to talk about financial technologies and SMEs, and the reason why this is such an interesting topic is because these technologies basically enable small and medium businesses that are the fuel of our economies, right? And these technologies also allow the consumers and the customers of these small, medium businesses to be able to buy more and enjoy more. And so it's an interesting time right now with COVID, because when you look at small, medium businesses, they're responsible for 60% of new employment, 70% of employees on average, depending upon the region, work for small and medium businesses. In some areas, 50% of GDP is attributed to small and medium companies. And so having technology that facilitates the funding of these organizations in such a way that they can flourish couldn't be more important than it is right now, especially with COVID. And just to give you a little bit of a sense of my journey, I mean, obviously you've heard a little bit about my background, but I've always been at the crossroads of technology and new and markets, right? And so when I finished at MIT, it was right around when the web browser came out. So I became the head of technology at Hearst and Disney, building out the first consumer websites. And I have to be honest, at that time, I'm not really sure that anybody in the media space ever thought that the internet was going to become so much bigger than broadcast TV, for example. I then went on to head up e-commerce at Oracle. And in that role, I remember going to retail companies who said, oh, nobody's going to shop online. Everybody wants that retail experience. And you look at us here in this COVID era in which, e-commerce has become, bigger than it ever was, right? It's fueled the ability to get deliveries, right? I then from there became a co-founder of a very successful internet service provider called OneMain, which we took public, had a very successful IPO. We grew it to be one of the 10th largest. And from there, I moved into a role as CEO of a company that was using machine learning and computational linguistics in order to be able to improve communications. And then from there, I went on to FinTech, in which data and cloud and networking was critical in terms of institutional finance. And about 10 years ago, I was walking down one of the halls at MIT, and I heard two students talking about, Bitcoin and this possibility of utilizing a hash to be able to embed that into blockchain and be able to have these data records and be able to prove that certain activities had taken place. And so I started looking at these new rails, and then went on to co-found companies utilizing blockchain in the healthcare space, in the insurtech space, fintech space, and then moved on into open banking. And what's interesting is that now you have all this incredible value that's digital. And so, of course, I had to get involved with cyber and cyber risk. And now advising a company on this passwordless access, one of the leaders in Europe, because protecting all these assets has become even more important. And so utilizing these principles of cryptography to protect data has become even more important as we start exploring the use of all these technologies for financial services, both on the small and medium business side as well as on the personal side. So with that, I'm going to get started. So small and medium businesses represent 90 to about 99% of organizations globally. It all depends on the geography. So for example, in Germany, the United States, you have more larger organizations, but in general, they are the fuel of economies, and especially when you get out of big cities into some more rural areas, they are the heart of those economies. And so it's really, really important to understand what their requirements are to grow. They are the fuel of our economies. And so FinTech is the only way to kind of fill that gap. And the reason is because they're all so diverse. And so the ability for traditional banks to be able to use the same traditional mechanisms by which to evaluate and serve these small and medium businesses is just very, very difficult. And what's interesting is that this creates an opportunity both for partnerships as well as for the ability to create fintechs. And we're going to talk a little bit about that later on in the presentation. But it's an interesting ecosystem that's evolving that creates opportunities not just for the small, medium businesses and the general economy as a whole, but also for the institutional organizations as well as the startups that will evolve that are serving this economy. So this is a chart from KPMG that's just sort of interesting. It just goes to show you that the level of investment in fintech companies continues to grow. Of course, there were a couple of big investments in the third quarter of last year that sort of made that number even larger. But in 2019, there were $135.7 billion worth of investment that represent 2,693 deals in total. The Americas and Europe have done really well, much better than Asia over the course of the last year. Of course, Asia has been doing really well in this space. And KPMG predicts that the rise in big tech, digital banking licenses, partnerships, open banking, which we can talk a little bit about, product expansion. The fintechs require a more diverse and specific type of services that are being supported through technology. And of course, I've talked about cyber because now you create all this digital value. You have to understand how to protect that. So as I've been saying, small and medium businesses, they drive economies and they are the driver of job creation. they have very difficult time securing proper financing. Partially is because they're all so different. So, for example, in the United States, it may be of interest to a small company to actually, pull out all of the profits at the end of the year in order to benefit from a lower tax base on a personal level versus paying both the corporate tax and the personal tax. And so there are a lot of reasons in which the financials may not look the same as it would be for a larger company or publicly held company. And so these different organizations have very different requirements. For example, if you're borrowing money in order to buy a piece of equipment, I mean, that lender has to understand what that equipment is worth on a secondary market. So the texture and diversity of those small businesses are very, very complicated. And so without technology, it's very hard to service that market. And of course, FinTech is transforming through connectivity and the ability to provide these, portals and capabilities through the internet and be able to share this information and pull this information through connected technologies. So just to give you a bit of appreciation for when I talk about the small, medium size of the employment, in this particular chart, which comes from the OECD, which is a national organization that's focused on sort of economic development, it shows you all the different countries and the sizes or the contribution based on size. So micro firms, which are anywhere from 1 to 9 individuals, for example, in Turkey, it's above average. You have a lot more micro firms, right? And then the small companies, which are between 10 and 49 employees, and then you have medium-sized firms, which are between 50 and 249. Of course, in the United States, I think medium-sized firms are anything under 500, but in this particular metric, it's measured this way. And so the OECD looks at this as micro, small, and medium-sized enterprises are responsible for 70% of the employment, right? So 1/3 of that is micro, and 2/3 on average tends to be small and medium businesses. So it gives you a little bit of a flavor of why it's so important for these small and medium companies to have the financial resources that are facilitated through FinTech. So here's just to give you a sense. I mean, this map here, which is from the Small and Medium Enterprise Finance Forum, gives you a sense of sort of where the gap is. And of course, there's a representation on the bottom of this chart that gives you a sense of where the gap is larger. But in general, the funding gap is close to $5 trillion, $5 trillion. And it represents, this market represents, 7 out of 10 jobs. And they contribute about 50% of GDP in countries. So start putting this in the context of COVID and the impact of that, right? So here's an example in Turkey, right? So there are about 2.6 million micro companies, right? And then out of that, pie, in comparison, the small and medium enterprises are about 77,000, right? But now let's look at how that, that moves into the finance gap, right? That small and medium enterprise businesses have a larger gap of 73%. But if you fill that gap, that's 35% of the employment of the whole country. So you can start to see why this is an important area and why FinTech is so important. This is a chart from the World Economic Forum that was trying to show an impact on companies around the world in countries that had recommended workplace closures, which is the top of the graph, the darker red, as well as countries in where it was required that they'd have workplace closures. And you can see it was almost like 90% at one point. And so the UN International Labor Organization predicts it's 1.6 billion suffered massive damages, which is a cost equivalent of about 350 million full-time jobs. And in the United States, the SBIC, which focuses on small businesses here in the United States and defines small and medium businesses below 500 employees, has accounted to be like 60 million jobs. This is 50% of the overall labor workforce in the United States. And this is 80% of them were indicating that they had cash flow issues, and with $18 million worth of jobs at risk. So you can see the impact of COVID and the correlation and the interest in being able to support the small and medium businesses, and why FinTech plays such an important role in this. So there's an organization called Edelman, and Edelman creates this survey, which is called a trust survey. They've been doing it about 20 years, and they survey people all over the world about how they feel about the services they get from certain markets, specifically around trust. And in this particular survey, they did a special survey around COVID, around job fears, and they noted that 59% of employees worry that they will lose their jobs as a result of COVID. But if you look at the financial services, I mean, that number is greater in financial services than it is in any other market. And part of the reason is because there's this feeling and understanding that AI and robotics are going to start to penetrate this space, and then worry about losing their jobs. And of course, you have all these articles coming out. One, Barclays had actually, the CEO was quoted as having said that he's questioning whether or not he should put 7,000 people into the buildings at Canary Wharf with, the situation with COVID. And then, of course, there are all these articles about the adoption of artificial intelligence and how many people will lose jobs. And I'm hoping that through this presentation, you'll see that there's a lot of opportunities to create value and to be able to partner with fintechs in order to create new solutions. So once again, this is the Edelman Trust Survey that I had talked about. And of course, the trust in technology has been greater than it has been with banks and financial services, and which is kind of interesting, right? And so banks and financial services are totally based on trust, and there's more trust in technology, which is why you can see that the market is primed for fintech services. So what is creating the digital transformation? So COVID is driving part of it, and there was this great quote in the Harvard Business Review that said, "One of the most obvious consequences of the pandemic will be the infusion of data-enabled services into more aspects of life than ever before," right? And I love this survey quote, who led the digital transformation of your company? Is it CEO, CTO, or is it COVID? And honestly, COVID, I think, has driven a lot of people towards electronic and digital transformation. So here's an interesting survey that was done by J.D. Power Associates, and their results were published by a company called the Financial Brand. And one of the things that they found is that 1/3 of customers increased their digital services as a result of COVID, right? Which is very interesting. And so if you drill down, you see that 1/3 of retail customers are increasing their digital banking, especially things like mobile check deposits and P2P payments, which is person-to-person payments, which are sort of direct mechanisms of paying. But many people plan to use more mobile and online mechanisms. So that's 36% of the people that have been polled. In terms of 40% of the people that were polled about using the branches, they of course had difficulties accessing branches. And the people who didn't bank online are slower to transition, but the ones that have been using at least the desktop are now more inclined to use mobile apps for their banking needs. A lot of the folks that are concerned, about 20% of them had expressed concern about going to the banks. But this whole area of payments, which is one of the areas that has been growing the fastest in terms of this whole digital transformation, there's a larger number of organizations, of individuals who are claiming that they're going to be using payments electronically. What's interesting is that the larger institutions have a lot more infrastructure, right? And so they've been learning a lot more about their customers using the data. And so they're more entrenched in that customer journey than maybe some of the mid-sized banks. So it'll be interesting to see how they fare. Of course, another area of transition is the changing needs of generations. And so millennials and Gen Z, which Gen Z is the population that came after millennials. I mean, they're basically digital natives. And if you look at that Edelman survey that I just showed you, you can see that they're more comfortable using technology probably than going to visit a bank, right? And so here on the bottom is a chart by the Financial Times and the UN that kind of shows how the population growth of millennials and Gen Z is sort of changing the landscape in terms of the demographic of our population as a whole, right? And what's interesting is millennials represent 35% of our workforce. That's 35% of the workforce. And of course, now Gen Zs are entering the workforce. So it's completely changing the way people work, the way people bank. It's a big driver in this digital transformation. So 40% of global adult population is under 35, right? Think about that. I mean, granted, 2/3 of them are, these millennials are in Asia. And of course, they've been very, very successful in this digital transformation. But this makes a huge impact on how they want to bank, right? How they want to work, how they want to transact with small, medium businesses. They are digital natives involved in social media. They have different ways of making decisions. They obviously have a greater demand for digital banking. What's interesting is that they're going to inherit a lot of wealth. And when they inherit a lot of wealth, they're going to manage it differently. They'll set up family offices. They're much more concerned about the environment and sustainability. They're going to make their investment decisions differently. They'll probably invest in crypto before they invest in other vehicles. And what's interesting is that they also want to be self-employed and entrepreneurs. So 27% of them are self-employed and 54% plan on being entrepreneurs. They want to move into the small and medium business area. So what does that say about the need for fintechs and banking? That's going to evolve. So here are the forces that are changing. So we talked about people, we talked about trust, right? Regulatory compliance has increased tremendously, right? I mean, we look at the anti-money laundering, the AML5 in Europe that's just gone into effect. You look at know your customer, which, the bar on that for the crypto exchanges has just gone up. You look at tech, these platforms that offer finances somewhat transparently, just at the point that you need it. It's not like you have to, go out and seek financing, and all these very clever mechanisms by which to enable a purchase or the ability to use a service just in time through financing. The use of data is incredible, and that's what's fueling the ability to be able to serve this diverse population, both of small and medium businesses as well as individuals. You have new business models, and COVID isn't the only driver. It's just making it happen a lot faster. You have a global world with global needs and global competition. And then, of course, the cyber risk. I mean, these hackers are becoming much more clever than ever before. In the first couple of months of the whole COVID situation, I mean, I think the number was like 660% increase in phishing. And then yesterday, I read a study about over 10,000% increase in other parts of cyber risk. So let's talk about the transformation of financial services. This is what's really exciting. I mean, so we talked about, we talked a lot about cryptocurrencies over the last, 5 years, especially during this hyper innovation phase. And there was a lot of talk about financial inclusion and how that was going to enable cross-border payments to be a lot more effective, and it was frictionless. And people were saying that, the dollar's a reserve currency was going to disappear, which isn't necessarily going to happen, although there's been a lot of investment in the infrastructure. If you start looking at what the central banks and all the work that's being done, even specifically by the United States with respect to providing liquidity in developing countries during this crisis in order to maintain the flow of money, you start to realize that the rails aren't extending into these ecosystems far enough in order to make that happen. Of course, with all the money being pumped into the system, this deflationary area becomes a little bit more interesting with respect to the investment principles of Bitcoin. You see a lot more institutional growth. What's really, really interesting, you think about central banks and things like metrics like the velocity of money, and the blockchain ecosystems, if you look at blockchain.com or some of these other sites that are creating these economic metrics, you have a tremendous amount of transparency. And even with respect to the companies like Chainalysis that are doing forensic work on the blockchain, the level of transparency blockchain is great. New financial models, hopefully as liquidity increases, there'll be new fractional ownership. But the financial inclusion piece of it just hasn't quite happened. The rails do not extend to that point. What is happening, though, is that with PSD2 and open banking, the use of data is what's making it possible to create and be able to service these, very complex and different small and medium businesses and consumer needs. And there's a tremendous amount of innovation that's happening through the use of data. So for those of you who don't know, PSD, there was a European Payment Services Directive, was first about, making payments throughout Europe a lot easier. But then when PSD2 came out, sort of an extension of GDPR, which is the fact that you own your data in Europe, that has actually, made it possible for, PSD2 has actually made it possible for organizations to, or individuals to be able to make their data available to a third party to be able to get, new types of loans. I mean, because that data is, locked up into a financial institution. What's interesting is that with all these fintechs, there's all this data on your phones. And if you have an Apple app, for example, versus just a regular app, the amount of data that you have that's accessible through your phone to these providers is amazing. As a matter of fact, there was one CEO of a fintech in Asia that was at a conference, and he talked about how they use the level of your, how many times you run out of battery as a metric for understanding whether or not you're going to pay back a loan. Because if you're not responsible enough to keep your phone charged, are you really going to be responsible to pay back a loan? And so there's all this data that allows for different forms of measuring the behaviors of people that are going into sort of assessing and driving these new fintechs. There's a great talk by Angela Strange. She's from Andreessen Horowitz. And she says any company can offer financial services. And today, you'll see, we'll talk about a couple of examples today. There are many organizations in the tech space that are embedding financial services, under the covers, just that point in time in that workflow when you need it in order to expedite the purchase and enable you to buy it in a more seamless way, a more economic way. And what's interesting is that, not that long ago, before AWS, Amazon's cloud services, you used to have to set up a rack and, set up your servers. It was expensive. It took time. You'd have to get licensing from, the regulators. That would take years and money. You'd have to set up core systems, tie into all the financial systems in which you're trying to pull data out of. You'd have to set up payment mechanisms, either through expensive vehicles and existing financial firms, or you'd have to build your own and create your own mechanisms. Then, of course, there's all the use of data. There's the regulatory aspects. Even today, you have a growing requirement for know your customer and anti-money laundering. And then there's new types of fraud. I mean, the level of creativity that hackers have is incredible. And so if you had to build all those services yourself, I mean, you wouldn't be able to get your business up and running. And so this whole idea that you can get those services as a service and just rent them as you need them means that you can take all those building blocks. You don't have to build them. You just plug into them, and then you create the user interface, and it allows you to build a fintech or incorporate that into your platform somewhat seamlessly. And so, for example, here in the United States, there's a company called Plaid that was recently acquired for $5.4 billion from Visa. And Plaid, basically, I talked about PSD2 and open banking. Open banking is the sort of British version of the European PSD2. And PSD2, as I mentioned, was the ability for you to permission third parties to be able to get, be able to give them your data in order to be able to assess whether or not you should get a loan. Well, we don't have those regulations here in the United States, like open banking in the UK and PSD2 in Europe. So Plaid has actually created all that plumbing so that if a FinTech builds an interface and needs that plumbing and that capability, they just rent the service from Plaid. And 80% of FinTech apps on your mobile phone in the United States are powered through Plaid without the regulatory piece. But these are all as a service. And so your ability to get up and running with very sophisticated components is a lot easier right now. So the reason why embedding these financial transactions is very interesting is because, one, it reduces the friction of the customer journey. And if you recall, when Tim Cook talked about the relationship with Goldman Sachs's credit card company and talked about the results in the fourth quarter of last year for Apple, he accredited the growth in Apple iPhone sales to the fact that the capital was there for consumers to be able to get a loan for a phone. And so both Goldman Sachs as well as Apple benefit. It was a win-win for both of them. But so the friction on that customer journey gets reduced when you embed these services as a just-in-time. It also increases sales, as I just gave you that example. But it also reduces the customer acquisition cost. And for some of you who've been following this space, there was a quote that if you wanted to buy, customers through Google search, that business is like a $50 billion business for Google, the AdWords for just insurance and FinTech alone. And so the idea that you can get customers by embedding into one of these technology platforms as a partnership not only increases revenue for both parties, but it also reduces the cost for customer acquisition. So let me give you some examples. Square is an interesting one. That started off as see the box on the bottom left of the screen. It was a device that allowed for small and medium businesses to be able to quickly take payments without having to have that huge cost of the traditional payment mechanisms. And you'll see that in farmers markets, and a lot of small and medium businesses will actually utilize this device. But what's interesting is not just that piece of it, is the fact that they recognize that this area of the market needs, they need services, right? And they don't have full-time CFOs with very sophisticated access to financial services. They need help, right? They usually have less resources than large financial institutions. So if you look at the ecosystems that they've developed, the financial services, payments, marketing services, they even offer, for example, the ability to create invoices and appointments and do payroll. These are all very important services. And, large financial institutions aren't really utilizing their data that they capture and offering these kind of services to the small and medium businesses. Look at Shopify. They started as a small sort of merchant platform, and they grew to the point where 55% of the revenue comes from merchant services. Think about it. They're basically a sort of a retail tool platform, and they offer tech, but 55% of their revenue comes from merchant services. And they grew by 53%, whereas the rest of the platform grew by much smaller percent. And in the fourth quarter alone, it was 63% of the revenue. They've launched things like Shopify Capital and POS, point of service credit, and business accounts and lending. Here's another company that has also decided that in order to be more competitive and attract the right drivers to their business, they needed to create a bank, because many of the drivers didn't have, banking services. They also realized that people wanted to be able to collect the income that they get from the rides on a faster basis than waiting at the end of the month or the end of the week. And so they make it possible for Uber drivers to be able, and same with Lyft drivers, to be able to get cash right away at the end of their day, at the end of their week. It's interesting, in Mexico, I guess only 37% of them actually have bank accounts. And so, being that it's a cash economy, they did a partnership with BBVA in order to be able to provide the ability for them to be the drivers to be able to get their cash on a regular basis. So it's an interesting way of solving a problem by providing financial services that's like a win-win. It's done through partnerships as well. So it creates a lot of interesting opportunities. And of course, Lyft also provided these capabilities. They both offer cards for their consumers with cash back, and they offer things like discounts for their drivers and help with, for example, rental cars. And so they have some drivers that can't even afford to buy cars, and so they make it possible for them to rent the car, so they have to make the investment in a car. So they've gone out of the platform of providing ride services into financial services, and it's actually become a lucrative part of their business. Amazon, of course, is a company that's in the headlines a lot because of the, of all the services they're providing, especially during COVID. And if you look at all the different services they provide in the financial space, I mean, this is a chart by CB Insights. It says Amazon is unbundling the bank. Just a couple of weeks ago, they announced a partnership with Goldman Sachs to provide about up to $1 million of credit for small businesses. They also were providing credit for their sellers, because think about it, they don't have to go to any of these credit organizations to figure out, anything about any of these small or medium businesses that sell on their platform. They know what products they sell, how popular they are. They know if people will buy their products, if they're returning their products. They know what the turnover is. They know a lot about their businesses. And so they're in a very good position to offer them financing, which of course they have. And so they, of course, offer financial services. And Goldman, who now considers themselves to be bank as a service as well, part of their announcement, is also providing financial services for Amazon as well. So here, just to give you a sense, because I've talked a lot about different ideas, but just to sort of organize in your head the different ways these financial services are being presented. So, one slice, and this is a chart from Accenture, divides it into 3 different categories. One is peer-to-peer, right? So that people can lend to other people. So you provide a platform by which people can lend to other people. Then you have the online lending, which is facilitated by investors, and the risk is by the platform itself, which has become much more sophisticated. Some of these models that I've discussed today. This is sort of the online banking. And then you have the FinTech, which has been around for a lot longer. And one of the great examples of sort of FinTech and having the advanced credit scoring is a company called Capital. The Capital cards. They are probably one of the largest credit card companies here in the United States. And in the early 90s, they tried this example in which they started offering cards to sort of that group of users that didn't make a lot of money and looked very, very risky. And granted, they lost a lot of money in the first 2 years, and the competitors thought they were insane, but they gathered a lot of data, and they created this advanced credit scoring mechanism that allowed them to figure out these are the characteristics of the people who will pay, and these are the ones that don't. And as a result of that, they're the largest credit card company there is. And so they're in this category of companies that have been utilizing data to differentiate themselves. So here they talk about these categories. I'm not going to go into all the details, but for example, working capital, very, very important, right? And so you have the fintechs like PayPal, Square, Ant Financial, Shopify, Amazon. They're taking all this data, and then they're able to sort of assess and make these quick loan approvals and facilitate the lending, right? Then you have QuickBooks. QuickBooks allows for accounting, and a lot of small businesses use that. But what's interesting is that they understand the business better than anybody else's because they've gathered all that data. Then you have platforms. Obviously, we talked about Amazon and Square and Ant Financial. They have this just-in-time capability of providing financial resources, but they also gather a lot of data that makes them capable of understanding their risk. Equipment finance is a very interesting space, and what's interesting about that space is that it's a big requirement. So think about a farmer that's trying to rent a tractor, or you think about things like let me see, a dentist who's trying to buy an X-ray machine. When they go to a bank to get the financing, those banks don't understand the complexity of all these different pieces of equipment that a small medium business needs. And so that becomes rather tricky. So without a form of capturing that data, understanding the marketplace, it's very difficult to service that. And what's interesting is that those small businesses will probably pay the loans on those devices faster, or they'll prioritize them over maybe their car and their home, because that's how they make their money. And so, this is sort of an example of these growing areas in the fintech space. Line of credit, of course, there are a variety of different organizations that are offering line of credit, things like Lending Club and Cabbage, On Deck, which also gathers a lot of data. And I'll talk a little bit about a partnership they've done with Chase, because they understand that small and medium data. Invoice factoring, which is big in Europe. I listed a bunch of fintechs in Europe. The very fragmented market, but also very important. Point of sale retail. Of course, this is an area in which, iPhone and Goldman Sachs with their Marcus credit card, helped both Goldman make money as Apple. But there's also, for example, the ability, if you're, at a Home Depot or Lowe's or one of these places where you're trying to buy a refrigerator, a large piece of equipment, and you get to the to the register, and you need to find some form of financing in order to pay for that. It's a win-win for both, right? But the use of new forms of data makes that process a lot easier. The peer-to-peer marketplace is one that's been growing, and that's the ability for people to sort of invest in lending amongst amongst with their peers. And there's a number of organizations that are in that space today. And of course, the incumbents, there's Marcus, there's the Goldman credit card, OnDeck is working with Chase, Apple Card. So this is the consumer lending space. And think about it, the consumers are the ones that are buying from the small and medium businesses. So when customers and consumers have an easier way of getting credit or financing, it makes it easier, right? And one of my favorites in this space is a company called SoFi, Social Finance. And after 2008, the financial crisis, college students weren't getting credit cards thrown at them by the by the banks like they used to. And so as a result of that, the credit agencies that had been collecting information from these students the moment they received those cards, and they would sort of grow in their credit history. And so then when they go to buy a house and a car, there would be a large track record in terms of their financial history. And so as a result of the financial crisis, that didn't really occur at that level. And so as a result of that, SoFi looked at individuals as social capital. And what are their accomplishments? What's their education? What kind of grades? What kind of school did you get? What kind of a career do you have? So the value of you as a human being in terms of the work that you're doing, they felt that was a better metric than just looking at your payment history, especially when it came to students. And very, very exciting use of data. Career training, there are organizations that are now providing mechanisms to fund your education, and then you pay them back as soon as you start getting a paycheck. Mortgages. So this whole space is becoming so much more creative than the traditional banking mechanisms. And there's lots of opportunities for partnerships, both with technology and incumbents in this fintech space. So why collaborate? Why collaborate? Well, first, I love this quote by Alex Rampel from Andreessen Horowitz. The battle between every startup and incumbent comes down to whether the startup gets distribution before the incumbent gets innovation. So you can see that both have their issues. I mean, startups, their startup costs in terms of their rails, they're just renting it so they can shut it off quickly. But their costs are going to be higher than a large financial institution that has a lot of expense in regulatory, KYC, AML. There's a lot of expense in there that's built into their ecosystem. That, from a collaboration perspective, there's a win-win there. You know that only 7% of credit products in banks can be handled digitally from end to end, right? So it's an interesting opportunity for a partnership, but only 20% of these large incumbents, financial firms, are actually pursuing partnerships. So collaboration versus competition. When it comes to a fintech, they have agility, innovation, cost reduction. I mean, they don't pay for those huge skylines that we're all so proud of here in New York and London and all these beautiful cities. I mean, I don't know who's going to fund the future ones, but they don't have the same level of expense. And so it's easier for them to launch new products and handle data. On the traditional banking side, they have lots of infrastructure in terms of risk management. They have regulatory licenses that they've invested in and personnel that are dealing with that. They have infrastructure. They have customer trust, economies of scale, and branches. And so if they two work together, it can be a win-win with respect to the products and services that they offer. Here's a chart from Banco Santander. This is an example of that, right? So this was published in The Guardian. And what's interesting, if you look at the fees that are associated with sending $10,000 through Santander versus sending it through a startup called TransferWise that came out of this whole open banking in the UK, the fees for TransferWise are $64, whereas for Santander, when you stack up the fees of their bank, the spread between the two currencies and then the corresponding bank, that comes up to like $585 for the consumer or the institution that's using that. So in order for them to maintain a level of competition, they have to bring those costs down like by 84%. And so here's another example. I mean, one of the organizations that is in this sort of rent a service or as a service is a very interesting company called Cross River Bank. They're located in New Jersey. They have about 300 employees. It's like several billion worth of money under management. I mean, they're an incredible organization. They don't have any branches or offices. I mean, they basically work with companies like Square and Coinbase. And if you look at this chart, which is provided by Andreessen Horowitz, you look at the return on equity and the return on assets versus traditional banks, you see that this partnership actually does have returns. And this banking as a service is something that is a win-win for everyone, and probably makes sense as to why Goldman's announced that they are banking as a service, and they've launched that as part of their brand very recently. As I mentioned before, they're providing bank loans, through their Marcus credit card with no late fee. I mean, they have to pay the money back, but no late fees, and there, no fee structures around their loans. They launched the Apple credit card. They spent about $300 million, did it in record time, and they lent out about $10 billion worth of credit in the first month. And I said before, Tim Cook was saying that they accredited the increase in sales of their iPhones in the fourth quarter of last year as a result of that partnership, that just-in-time credit that was available through this card. Amazon has also just done a deal with Goldman Sachs, providing $1 million worth, up to $1 million worth of credit to selected suppliers. And they had been, Amazon had already been working with Bank of America as well. On Deck is a company, it's a FinTech company, focuses on small businesses, really understands loan data. And they did a partnership with JP Morgan, which is a large organization, 2.6 trillion in assets, right? 100 billion in revenue. And they helped in providing small loans for small businesses because On Deck knows how to look at the cash flow information and be able to understand the risk associated with certain loans. BBVA Compass also did a deal with On Deck as well to help them underwrite the loans. So if you look here at this chart from Bloomberg, you'll see that in the third quarter of last year, the credit card business is a very large piece of their growth. So there are a lot of different benefits that come from collaboration. I mean, obviously, the enhanced brand reputation, lower capital expenditures, lower cost of business, cost less to acquire a customer. But it's this expanded mobile banking function, especially during the COVID crisis, becomes much more interesting. And so in the United States, we had these loans. They were called these paycheck protection program loans that were provided by the government. And what's interesting is large organizations like Chase and Bank of America had a very difficult time facilitating that distribution. And so as a result of that, these organizations like Cabbage and Square, they stepped in and they were the ones who were able to provide these particular loans. So there are a variety of different ways in which fintechs are competing with loans. And so, look at the majority of small, medium businesses, 51% of them use big banks, but 67% of them use these these payment platforms and the accounting software, digital banking, all the ones that are on this chart. And the end-to-end journeys are better understood by these small and medium businesses, the fintechs that service them. And so when you look at the growth of fintech and the potential in the loan business, here's a chart. It goes up to 2017, but you can see there's a growth in the amount of money that's being provided and lent out through fintechs versus banks, credit unions, and traditional finance. As a matter of fact, banks, credit unions, and traditional finance aren't growing at the same rate as the fintechs are. And so one last thought, the World Economic Forum has created this chart as a mechanism for understanding sort of the core areas of fintech that are required to serve all populations. And so what's interesting is one of the ones that they defined as being critical is the payment space. And they've basically accredited having these electronic or fintech payment capabilities as driving GDP in countries. And so all of these areas, which I've sort of touched on, have been identified as 6 core financial functions and 11 clusters of innovation. And so I hope I've given you a lot of ideas in terms of innovation and fintech ideas that will help fuel the economy, especially in this pre-COVID space. So with that, I'd like to hand this back over to Yijid in order to facilitate the Q&A. So thank you for this opportunity, and I hope everybody enjoyed it.
Thank you, Cristina, for your talk, enlightening talk. A couple of questions came up during your talk, and I also have a couple of questions of mine. So you actually already answered one of them. Like one question was, what are different types of fintech? You already laid out a detailed geography of different fintech services. One question is, it says due to the regulations, fintechs burn a lot of resources while establishing, and can a different scenario be created? I guess the question has to do with the economies of scale.
So it's interesting because especially with the AMLD, anti-money laundering, and the KYC aspects, because the bar is going up with respect to regulations, specifically in that area. And there's been a lot of discussion in terms of, for example, creating consortiums for KYC and using these sort of cryptographic capabilities to be able to sign your credentials and be able to use a third party, so that there is sort of an accredited, third party that you can sort of rent out as a service to be able to do that. I mean, there obviously are companies that are today providing the KYC as a service, or anti-money laundering. In the crypto space, of course, there are companies like Chainalysis, and there's a variety of them that are kind of in that space and providing that for the exchanges. It's sort of, because it's become a requirement for them to be able to do business. But even in the your traditional payment space, this is becoming a big requirement. And so once again, there are a lot of very creative solutions that are coming up. And also another area in the hacking space, because of the fact that the hackers are becoming so clever, they're like, for example, in the United States, there's ways to trick the system by creating fake IDs and social security numbers. And then if you make up a number enough times and apply for loans and then pay them back, you start creating fake credit histories that look good, and then they'll take out a loan and not pay it back. There's all these really clever mechanisms that are now being serviced by these cool sort of regulatory as a service solutions. So it's interesting that that chart that shows all of the rentable services for regulatory aspects, as well as even, and of course, cyber is part of the regulatory landscape in the financial services space. But, there's a lot more that's coming as a result of the increasing regulatory bar. I don't know if I answered the question.
I think you did. Thank you. I have one question of my own. So developing markets obviously present a lot of opportunities for fintech. For example, if I'm not mistaken, the early fintech companies, those disruptors, were first active in payment services and like P2P lending. and they were very successful in countries where not everyone has access to traditional banking services, but everybody has a smartphone. Now, the context of your talk today was the role of fintechs in business lending also. Yeah. Like, what opportunities do you observe in developing countries such as Turkey in that context? And as a follow-up, maybe as an entrepreneur yourself, do you have any advices for aspiring entrepreneurs in this field?
So I think the payment space was one that the World Economic Forum has identified as being one of the most critical areas, because that alone, once you have sophisticated mechanisms for payment and you have the ability to store value and send value, the velocity of money, starts to move around. And, people talked about cryptocurrencies helping with that, but I think actually this PSD2 area has actually been more interesting. And so once you start utilizing those tools and you develop a history of payments and receiving payments and making payments, and then the ability to be able to use that to assess risk becomes interesting as well. And so I think that there's a couple of areas. I mean, I obviously think that the large financial institutions have a lot to offer the fintechs. And so this whole idea that Goldman is now pursuing of banking as a service is, I think, a really critical service, because the regulatory barriers, I mean, you can spend a lot of time and money just getting through that and setting yourself up. So companies that are interested in pursuing fintech opportunities should really look to partner with the large financial institutions as a mechanism for, decreasing the amount of money and time they spend setting themselves up. And then once they get beyond that partnership, I mean, you need to have a different value proposition. But I think that the large financial institutions don't really necessarily focus on smaller markets. So whether that be renting equipment, where you need to have a lot of knowledge about the particular type of equipment, right? Or if there's a particular industry niche. So having that core industry knowledge, bringing that to the table, and then being able to offer just-in-time services, and then embedding yourself into these workflows and platforms creates new opportunities. But there's a big element of partnership to make this sort of a win-win and decrease costs.
I have one more question, which is coming from one of our attendees. She says, how should fintech companies approach to unbanked and underbanked groups to increase their penetrations? Are there any particular trends to look out for?
Yeah, so it's interesting because everybody thought, the crypto space was going to address all of that, right? And it's interesting because the on and off ramps are somewhat complicated for crypto, and it's so hard to hold on to those private public keys, and that everybody takes crypto. So it's not really the answer. But I actually do think that partnerships with like phone companies, banks and phone companies working together, because while people may not have a bank account, but they will have a phone, right? And so then utilizing that as a base and then building applications on there, either as a fintech and creating that within the phone. As a matter of fact, there's some parts of the world in which people don't have identity. And so the phone companies are working with them to actually create some form of identity in order to be able to have them participate in banking, storing their money, and be able to participate in the economy. So as the World Economic Forum pointed out, this is a really critical piece of the entire puzzle that I showed on that last slide. And I think that starting with partnerships with the phone companies, because everybody's likely to have a phone even if they don't have a bank account, and using that as a base, working with financial institutions. And I know that Akbank is sort of very innovative. So I know they've sponsored this event, but I think I would look at partnering with the phone companies first, because they have those individuals and they have the technology in their hand to actually build on top of, and then utilize that as a mechanism to build the products on top of that. And I think that helps the velocity of money and helps people participate in the economy.
Thank you, Cristina. So before we conclude this webinar organized by Sabancı University's Center of Excellence in Finance and sponsored by Akbank, I would like to thank all our attendees for taking the time to participate in our event. We will share this webinar in our social media platforms in the upcoming days. I would once again like to thank Cristina Dolan'ın for enlightening us about the impact of digital transformation on financial services during these turbulent times that we're going through. Thank you for being with us, Cristina.
Well, thank you so much. And hopefully next time I'll see you all in person. So thank you so much. It's been wonderful. And really, once again, good luck with the implementation of some of these ideas.
Thank you. Those are our wishes as well. And we hope to see all of you in future webinars and hopefully physical seminars. Take care.
Thanks. Bye-bye.